What's up, everybody? My name is Mike Sharp. This is Sharp Investing, and I'm going to do Applovin today. They just released Q1, and once again, a absolute home run, and lots of really good stuff that they're talking about in the earnings call. Like, this company might be one of the best businesses in the world, and like just the financials alone are unbelievable. So we'll get into that in a minute. But I think I want to talk about the first is the big growth initiatives that they were talking about in the call. And so like this company is growing like crazy already, and they seem to be I don't, maybe not seem to be, but I think they could run away with their niche in the advertising space, because they're just, the flywheel is flywheeling right now. And so, but first of all, let's look at the past to, they call it step function growth, which means and then not just this sort of incline that we're seeing right now. These moves up like they had with the Axon model, Axon 2 actually recently, which is their AI model that improves the algorithm for advertisers on their platform and basically makes their advertisers more money. Therefore, the advertisers invest more money with them. It's quite, and then they get the data from all that new and increased advertising, which makes the Axon model better, which means more advertising because the model's better, because the advertisers make more money, and it just on it goes. And they could potentially increase this moat that they're building right now. So one of the things I talked about in the last video, they are getting into e-commerce. So this is fairly new, like 2 quarters old, where they're actually doing advertising for products, e-commerce, as opposed to just advertising other games. So this is a huge potential growth avenue, but there is an S curve involved, right? Where it's a very sort of slow startup because there's not as much data. People advertising, companies advertising on their platform, but once they hit the sort of critical point on the data in order to feed into their models, then they may hit this rapidly upsloping part of the S curve. Another one that's coming online now is the self-serve model, right? So they're trying to basically get out of the way of the advertisers that want to use their platform. And right now it's basically a bottleneck. That's sort of the way I understood it. They're talking about they have a line of advertisers out the door that they can't service yet because there is some non-automated part of the process. So they're launching this self-serve model where everything is basically the advertisers can do everything themselves, but they've launched it with a limited number of customers. Once that is established and all the bugs are worked out, they can open that up to other like all the other companies, and basically get out of the way of their growth profile, right? So amazingly, their growth is a little bit hindered right now, even though the numbers are berserk that you're going to see in a minute here, if you haven't looked already. The next one is personalized ad creation. So he's talking about the idea of if an advertiser wants to work with them, rather than coming with their own ads and their own videos, they may have a model that can just build these advertisements for the companies. And that would be a massive game changer, right? That opens the doors to a lot more advertising. Now, my company, we've created ads for customers in the past, and it's a major pain in the ass, right? It takes a lot of work, a lot of time to develop these ads. And if they could automate this process, via AI, and basically if you're an advertiser, you want to come on, you just basically put in what your goals are, what you want the advertisement to look like, and then they can build it for you with the information you give them. And the reason they can do that is because they'll have all these other ads. They have this huge database of ads. Like they say they have 1 billion customers, so it's 1 billion people playing games that they advertise on. And there's a lot of, again, the data feedback loop. They can actually figure out what ads are working the best, and then feed that into their ad building customized platform, right? So that would be enormous, right? And that's sort of down the road a bit. I understood that that's like probably a few years away. Maybe I misunderstood, but I think but basically you can see that it's not the end of the road yet, right? This might just be sort of, they might be 10% or a quarter of the way down the road, even though they're an extremely profitable business with high growth. So that one's very exciting, and I believe them, right? They everything they've talked about that they want to do, they've done, and they've done it well, right? So I have no question about whether they're going to be able to do this kind of stuff that they're talking about. Whereas if you're following Meta, I followed Meta for a long time. They get a lot of ideas, they get a lot of things wrong, and they mess a lot of stuff up. So they throw stuff at the wall, and some of it sticks. But these guys their batting average is pretty high. The fourth one is TikTok. So they are in the running to purchase the non-China version of TikTok, which, if they were able, he said it's a long shot. CEO said it's a long shot, but they traditionally sort of under pitch. They sandbag a lot of their potential. So I wonder if it's better than a long shot. That said, who knows, right? We'll see it when we see it. Whoever gets to buy it will benefit a lot. And I do think that data moat could potentially become impenetrable if they start getting the TikTok data, right? So let's keep an eye on that one. That would be phenomenal if they bought it. But I think it's going to be pretty expensive, and I'm not sure that they have the money to do it. I don't actually know what the price is. If it's 100 billion, it's not happening. Maybe. Okay, so let's go to the financials a little bit. I'll just go over some of these numbers here, which are, like I said, pretty crazy. So first off, revenue, you can see it's up 40% from quarter one 2024. Now that sort of hides the fact that the actual meat of the business is advertising business. Oh, and by the way, they are selling off their apps business, which is their game studio, or the game studios that basically have flat growth. They kick out some cash, but it seems like it's more of a headache now than a benefit. So they've sold it for cash and 20% of the business that they're selling it to. So they will still get a cash flow stream from this. And I think that's good to just focus on the core business, which is the advertising. In any case, the advertising, you can see it's growing a lot faster than the overall business, up from $678 million a year ago to $1.159 billion this year. Massive. The EBITDA has almost doubled in that part of the business, and we can see that 81% EBITDA margin is huge. Now I'll go into the EBITDA a little bit more later, but it's not a bad proxy for how much money they make. Now there are some stuff we have to take off there to get a realistic cash flow number, but it's still probably a relevant number. Okay, so if we look at net income, 576. The reason this isn't higher is because there was $188 million goodwill write-off this quarter, which is not relevant to their operating results. So if we back that out, you're going to see about $725 million in what's that word? Net income for the quarter, and very significant increase just quarter over quarter from 600 last in Q4. So still growing phenomenally. The margins are getting better, and they did mention on the earnings call that the flow-through rate from new revenue to EBITDA was 104%, right? And they backed something out and put it at 100%. But there's no interest attached to new revenue. The depreciation we don't really care about. The amortization we don't really care about. And then so the only real number to take off there would be taxes. Okay, let's look quickly at some of the financial statements. This is just overall revenue, advertising revenue up 71%, like we said. Adjusted EBITDA up 92%, crazy numbers. Net income up 144%, even more. It's actually up more than 200% if you get to 725 million, which I think is the adjusted income. This is their guidance for next quarter, right? So it looks like about 1.2 billion in revenue and about just under $1 billion in EBITDA. Now let's just call a spade a spade. This is BS. Like, they just crush these guidance numbers every quarter. So we don't believe them. I think it's going to be quite a bit higher. That might create a risk too, because everyone's expecting these big beats on guidance. If they don't beat by a lot, maybe the stock actually suffers for that. Who knows? Balance sheet, I think I'm going to ignore this time, but if you actually no, let's look at the return on equity here, right? So let's say we've got 725 million in net income after tax, adjusted net income, and we look at the equity figure is 575 million. You can see that the return on equity is over 100% just on a quarter. So that's like over 400% for the year, probably closer to 500%. So find another company with an ROE that high. Now, it is maybe a trick because they use all the excess cash to basically buy back shares, which sort of inflates their ROE number. Maybe inflates the wrong word, but if we look at the assets, we've got 5.7 billion in assets. And if we take 700 million, it's about 2.9 billion in run rate revenue. You can see the return on assets is over 50%, right? Even if you include all this goodwill and intangibles, return on tangible assets, that's over 100%. So really good return on capital numbers. But I think the income statement is where the juice is. So this is totally nuts to me, right? So revenue is up, like we said, a lot from last year, 40%. And you can see the cost, every cost category aside from G&A is down. So they're actually cutting costs in the midst of this huge revenue increase, right? So this company is fully on the AI train, and I think they are one of the leaders in terms of how to utilize AI to improve their business and unfortunately cut costs, which are people. So they are on the train where they don't actually need any more people. And that's why 100% of the revenue can drop to the bottom line. There's literally no other cost, right? And there's no CapEx. I think there was $125,000 of CapEx or something this quarter. So yeah, no cost to run this business. Interest expense, 53 million. Yeah, they could get rid of their debt instead of buying back shares. You could argue that, but I'm not going to nitpick about that stuff because the business is doing so well. If we look at the cash flow statement is pretty interesting too. So you've got 830 million in operating cash flow, right? And where's their, I think they had a free cash flow reconciliation here somewhere. Oh, right here. So here's your operating cash flow. Like I said, 138,000 in CapEx, and then they prepaid some leases, right? Which is the other number they're including in their free cash flow number. I'm not sure why, but basically operating cash flow is almost the same as free cash flow. So no investment needed. That's maybe the better gauge of how the business is doing if you're looking at rather than EBITDA. So that's at a run rate of over, well, it's right around 3.3 billion. So for me, I would use that number to do a valuation before the, let's see, if we go to the stock price here, before this $40 bump after earnings, they were trading at about 100 billion in market cap, and so that would mean they're trading at about 30 times annualized free cash flow from the first quarter, right? So we believe that the future free cash flow is going to be higher due to the growth, and the past is going to be a lot lower due to the growth. So I think annualizing the quarter is maybe the best gauge right now, because trailing 12 months is kind of irrelevant now based on the speed that this company is growing at. So that's nice, a nice little $40 bump here. But if we look at some quick calculation here, what this company might be worth, I actually don't think it's that expensive now. Like it, at first glance, it looks really expensive if you look at trailing 12 months. But we've got 345 million in shares outstanding, and I think this company could get to a $10 billion a year net income level in maybe 2 years, right? Given their run rate. Now that's not a projection. I find this really hard to project, but I don't think that that's out of the realm of possibility given the growth rates we've seen and the initiatives they're doing. So if they got to a $10 billion net income rate, put them at a 20 multiple, probably worth more at that point. But let's use a 20, means in 2 years the stock price could be around $580, which would be a 2-year CAGR of 30%. Like that's a pretty good return still, even though the stock is trading pretty expensive at the moment. Anyway, that's sort of what I'm looking at. If we did see another meltdown from the Trump tariff situation, I would love to see this stock back down at like 200, lower if we can. If we got to that level, I would probably rebuy a lot of the shares that I've trimmed already. But who knows? Can't really predict where the market's going to go. And who knows, this stock could just go to 500 in 5 minutes next week. Who knows? Anyway, great business. I don't know any other business that has 100% flow-through rate on revenue at this and growing at these levels. Like I've literally never seen that before. I don't think I've ever seen that before. So numbers are phenomenal. Prospects are phenomenal. Really hard to dislike anything here. Now, if we talk about, no, I'm not going to talk about that. So anyway, hope you got something from that. I'll catch you in the next video and leave some comments. Not investment advice. Thanks very much.